If smart money concepts feel confusing, the problem is not you. The problem is that you learn the pieces in the wrong order, or you get the incomplete version. This masterclass gives you the full sequence, from structure, liquidity, and volume, to zones, imbalances, and traps, plus the full chart execution. First, you need to know which side of the market has control. Let's start with the order flow. Order flow refers to the external swing points of the market. These are the key turning points where price changes direction. To identify these swing points, you need to zoom out and look at the bigger picture. Start by picking a higher time frame. Now, mark out the significant highs and lows on that chart. These are your external structure points. If you see that price is making lower highs and lower lows, then the order flow is bearish. This means that the big players in the market are actively pushing price down. If you see price making a series of higher highs and higher lows, then the order flow is bullish. In this case, the smart money are accumulating positions and driving the market up. Now, these big players don't just buy and sell randomly. They have specific intentions and goals in mind. This is where the concept of order flow comes in. By analyzing the external swing points, you can read the overall direction of the market. The key is to trade in the same direction as the order flow. Don't try to fight the trend or guess when the market will turn. Instead, focus on following the big players and riding the big waves they create. Now, one of the best ways to analyze order flow is to look at multiple time frames. Each time frame gives you a different perspective on the market. The higher time frames show you the bigger picture, while the lower time frames show you the details. The external swing points on a lower time frame are often seen as internal structure on a higher time frame. This is why it's so important to look at multiple time frames when you read the market. For example, you might start by looking at the 4-hour chart to get a sense of the overall trend. If you see a series of lower highs and lower lows, you know the order flow is bearish. Then, you can drop down to the 15-minute chart to look for specific entry points. On the 15-minute chart, you'll see smaller swings that are part of the bigger picture. These are called internal structure points. They're the building blocks of the larger trend. Thus, by comparing the 15-minute swings to the 4-hour trend, you can get a sense of how the market is behaving on a smaller scale. You then simply look for bearish setups on the 15-minute chart that align with the overall bearish order flow on the 4-hour chart. Trend is all about the direction of price over a specific period. It's the overall movement of the market. To identify the trend, you need to focus on the internal swing points on a lower time frame. Internal swing points are the smaller highs and lows that occur within a larger trend. Now let's talk about fractal alignment and how it ties together the order flow and the trend. So order flow is the overall direction of the market, determined by the external swing points, the big picture view of where price is heading. Trend is the current phase of that direction, identified by the internal swing points. It's like zooming in on a specific part of the chart. Remember this, the internal direction, the trend, actually makes up the external direction, the order flow. It's like a fractal pattern, where the smaller parts contribute to the larger whole. To really understand this relationship, you need to assess order flow and trend in relation to each other. This is where multi-time frame analysis comes into play. By looking at different time frames, you can see how the trend on a lower time frame fits into the overall order flow on a higher time frame. Let's say the order flow on the daily chart is bearish, making lower lows and lower highs. However, when we zoom into the 1-hour chart, we see that the current trend is actually making higher highs and higher lows. This is a common scenario that occurs when the order flow is pulling back. After a new low or high is established, price will often gravitate to collect more orders before continuing in the direction of the overall order flow. During this process, the trend on the lower time frame may differ from the higher time frame. As price navigates towards your points of interest, you need to wait for trend and order flow to align before entering the market. So it's all about looking for consistency between the time frames. If the order flow on the daily chart is bearish, we want to see the trend on the 1-hour chart also making lower lows and lower highs. If the trend on the 4-hour chart is bullish, you want to see the order flow on the 15-minute chart also making higher highs and higher lows. When trend and order flow are aligned, the market is more likely to continue in that direction. The next smart money concept is the break of structure. Looking at this price chart, you see a series of swing highs and swing lows. When price breaks above the most recent swing high and closes above it, this is a break of structure to the upside. It means that the old structure, which was defined by the previous swing high, has been broken. Price has now created a new structure with a new swing high in place. The same concept applies to the downside. If price breaks and closes below a swing low, it's a break of structure to the downside. The old structure has been broken and a new one has been created. A break of structure is viewed as a continuation sign. It tells you that the buyers or sellers have taken control and that price is likely to continue in the direction of the break. So to make it very clear, a break of structure is simply a break above a previous higher high in an uptrend or a break below a lower low in a downtrend. The change of character is another important concept. You're looking at this price chart and you see a market that has been in a downtrend for some time. Price has been steadily making lower highs and lower lows, and then price suddenly breaks above the previous major swing high. This is a significant event because it means that the buyers have finally gained the upper hand. They've managed to push price above a key level of resistance, and this could signal a potential trend reversal. This is what we call a change of character. It's a sudden and significant shift in the price action of the market. In this case, the change is from a bearish trend to a potentially bullish one. The key is to watch what happens next. If price continues to make new higher highs and higher lows, then we can say with confidence that we've transitioned into an uptrend. In an uptrend, a change of character would be signaled by a break below a previous major swing low. This would indicate that the sellers have taken control and that the trend may be reversing to the downside. If price continues to make new lower lows and lower highs, then we can say that we've transitioned into a downtrend. The premium and discount zones are very important in smart money trading. In this chart, the distance between a swing high and a swing low is called a price swing or a price wave. If you to measure the distance from the top of the leg to the bottom and you apply a Fibonacci retracement, you can get the premium and discount range. In general, anything above the 50% mark of the price swing can be considered premium, while anything below the 50% mark can be considered discount. When price is trading in the premium area, it's like gravity is pulling it back down. There's a higher probability that price will reverse and start moving lower. This means that selling in the premium area has a higher probability of success. When price is trading in the discount area, there's a higher probability that price will reverse and start moving higher. This means that buying in the discount area has a higher probability of success. Of course, you won't use the premium and discount zones as a standalone strategy, but by combining them with the other concepts, you can start to build a more complete picture. In this smart money approach, you will use the premium and discount concept to help you decide when to enter a trade. For example, if you're looking to go long, you might wait for price to pull back into a discount area before entering. If you're looking to go short, you might wait for price to rally into a premium area before entering. Now you know how to read direction. But direction alone is not enough, because the market does not move in a straight line. Price often moves toward areas where traders have stops, breakout orders, and emotional entries. That is liquidity. So liquidity means all the buy and sell orders waiting to be filled. Now, here's the interesting part. If there isn't enough liquidity, the big players, the smart money, will create it. For big traders like banks or hedge funds, liquidity is critical. They deal with large amounts of money. In less liquid markets, their big trades can push prices around a lot. This makes it hard for them to buy or sell without losing money. Now, if you understand where liquidity sits, you can identify magnet areas, those price levels that attract price movement. Your main task is to find liquidity pools. Liquidity pools are like busy trading spots in the market. They're areas where lots of buy and sell orders gather, and they form at key price levels. These could be previous highs or lows, round numbers, or other important points. We'll talk about these in a minute. Now, traders often place their orders at these levels, creating a cluster of potential trades. And there are different types of liquidity pools. Major liquidity pools, which form at the highs and lows of longer time frames. These are big, important levels that many traders watch. You might see them on weekly, monthly, or even yearly charts. Medium liquidity pools that show up on shorter time frames, like 1-hour charts. These are still significant, but not as big as the major pools. And minor liquidity pools that appear on very short time frames, like 1-minute or 5-minute charts. These are smaller and might only matter for very short-term traders. Liquidity pools work by attracting price. When price approaches a liquidity pool, a few things can happen. It might reverse, as lots of orders get filled at that level, or it might pause there before continuing. Sometimes, it might even break through quickly if there's enough momentum. And big players are constantly trying to hunt these liquidity pools. They often push price to these levels to trigger a bunch of orders, causing a sharp move. So liquidity zones are key areas where smart money players often target to protect their positions and to trap other traders. These zones act like magnets for price, drawing it in and often causing significant moves. So let's talk about each type of liquidity zone and how smart money uses them to their advantage. First area is around structural highs and lows. These are major turning points in price action, the peaks and valleys you see on a chart that stand out from the rest. Smart money loves these spots because they know traders often place their stop losses just beyond them. Let's say we have a strong uptrend with a series of higher highs and higher lows. Traders often jump on these trends, placing their stops just below the most recent low. And smart money knows this. They often push the price down, breaking that low and triggering all those stop losses. This flood of sell orders drives the price down further, often before smart money steps in to buy, at a discount. The same happens in downtrends. Retail shorts place their stops above recent highs. Smart money spike the price up, hit those stops, then drive the price back down. To spot these zones, look for clear swing highs and lows. The more obvious they are, the more likely they are to attract attention. Trend lines are another favorite tool of traders. The diagonal lines that connect a series of lows in an uptrend or highs in a downtrend. They're simple to draw and easy to understand, which is why so many traders rely on them. Big players often target these trend lines, especially long-standing ones. They know that many traders will have stop losses placed just beyond these lines. By breaking a significant trend line, they can trigger a cascade of orders. For instance, in a long-standing uptrend, many traders will be long, with their stops just below the trend line. Smart money might push the price down to break this line. As stops are hit, more sell orders flood in. Smart money can then step in and buy at lower prices before resuming the uptrend. Equal highs and lows, also known as double tops and double bottoms, are also exploited by smart money. These patterns form when price reaches the same level twice, creating a potential reversal point. Traders often see these patterns and place their trades accordingly. For a double top, they might go short, with a stop just above the equal highs. For a double bottom, they might go long, with a stop just below the equal lows. Smart money knows this and often pushes the price just beyond these levels to trigger stop losses before reversing. This creates a liquidity pool that they can use to their advantage. Trading sessions, particularly the Asian, London, and New York sessions, often create their own ranges. These ranges can become significant liquidity zones, especially at their highs and lows. Big players often target the session's highs because they know many traders use them for entries and stop placements. For example, many traders use the Asian session range as a guide for the London session. They might place buy orders above the Asian high and sell orders below the Asian low. Smart money might push the price just beyond these levels to trigger these orders, creating liquidity that they can trade against. They might spike the price above the Asian high, triggering buy orders, only to sell into this liquidity and push the price back down. The previous day's high and low are other significant levels that many traders watch. They often serve as support and resistance levels for the current day's trading. Again, the big boys frequently target these levels. For instance, many traders place buy orders just above the previous day's high, expecting the upward momentum to continue. Smart money will push the price up to trigger these orders, creating a pool of liquidity. They can then sell into this liquidity, potentially reversing the price direction. The previous week's high and low also attract a lot of attention. You might not even know where those levels are. These levels often act as key support and resistance on higher timeframes. And smart money often exploit these levels, knowing that many swing traders and position traders use them for stop placement and entry orders. For example, in a downtrend, many traders might place sell orders below the previous week's low, expecting the trend to continue. Smart money often push the price down to trigger these orders, creating a liquidity pool they can buy into. Supply and demand zones are other liquidity zones. These are areas where price has shown significant rejection in the past, and these zones are prime targets for smart money manipulation. Smart money know many traders place their orders around them. For example, many traders might place buy orders at a strong demand zone. Smart money might push the price into this zone, triggering these buy orders and creating liquidity. They can then potentially sell into this liquidity, driving the price even lower. That's why you see so many demand zones that should work in theory, but in reality, they fail. The same happens with supply zones. Traders often place sell orders at these levels, expecting price to drop. Smart money might spike the price into the supply zone, triggering these sell orders, then buy into this liquidity to potentially drive the price higher. Fair value gaps are also targeted. These are areas on the chart where price has moved rapidly. These gaps often act as magnets for price, drawing it back to fill the gap. Smart money often uses these gaps as targets. For example, if there's a bullish fair value gap below the current price, many traders might place buy orders in this area, expecting price to come back and fill the gap. Smart money might push the price down through this level, triggering these buy orders and creating liquidity. The same happens with bearish fair value gaps above the current price. Traders often place sell orders in these areas. Smart money might spike the price up through the gap, triggering these sell orders. That's why maybe 90% of fair value gaps fail, but that's a topic for another video. Round numbers ending in 0 or double zeros are psychologically significant levels that attract a lot of attention. These levels are prime targets for smart money manipulation. Smart money knows that many traders place their orders around these round numbers. They might place buy orders just above a round number or sell orders just below it. The big boys often push the price to these levels to trigger these orders, creating liquidity that they can trade against. For instance, if there's a round number at a $50 level, many traders might place buy orders slightly above it, expecting the price to rise above this level. The big boys might push the price up to trigger these buy orders, creating a pool of liquidity. They can then potentially sell into this liquidity, driving the price back down. Understanding all these liquidity zones and how smart money targets them is key. It helps you avoid common traps. As you practice, you'll start to see patterns. You might notice that price often reverses after taking out a previous high or low. Or you might see that certain levels keep causing price to pause or reverse. And please don't just draw liquidity zones all over your chart. Focus on the most important ones. Too many zones can make your analysis confusing. Also, pay attention to how price reacts when it reaches a liquidity zone. Does it reverse sharply? Does it pause and then continue? Or does it blow right through? This can give you clues about the strength of the move and what might happen next. You might notice that certain types of zones work better in certain market conditions or for certain currency pairs or stocks. This is where keeping a detailed trading journal with your findings can be incredibly valuable, allowing you to refine your strategy over time. Now, let's talk about liquidity inducement. Inducement is about creating situations that make other traders want to trade at certain levels. This creates available liquidity for bigger players to use when they want to enter or exit their positions. To understand this better, let's look at how the market is structured. When we look at charts, we see highs and lows. Above these highs, we assume there's buy-side liquidity, and below the lows, we assume there's sell-side liquidity. Buy-side liquidity is all the liquidity that buyers will use, created mainly by stop-loss orders of sellers and buy-stop orders of buyers. In a bullish market, price often uses buy-side liquidity to fuel the next upward move. To have a big bullish move, the market needs sell orders to generate more liquidity. Also, the buy orders from stop losses of sellers generate more buy orders, which is why you often see a surge in buying when price breaks out. Sell-side liquidity is the opposite. It's the liquidity that sellers will use, created mainly by stop-loss orders of buyers and sell stop orders of sellers. Imagine you see a double bottom on your chart. Price hits the same low point twice, forming a support level. Many traders might want to buy at this support level. Now think about where these traders would put their stop losses. They'd likely put them just below the lows. This creates a pool of sell-side liquidity below the lows. This is important because big players need this liquidity. They can't just jump into the market with huge orders. That would cause wild price swings and could work against them. Instead, they use liquidity inducement to their advantage. These big players create patterns or situations in the market that encourage other traders to place their orders in predictable spots. This builds up pools of liquidity that the big players can then use to enter or exit their positions. Liquidity goes hand in hand with the market structure. Market structure refers to the overall pattern of price movement. It's about identifying trends, key levels, and the flow of the market. Liquidity is about where buying and selling activity clusters. These two concepts work together to shape market behavior. Here's how they interact. Areas of high liquidity often become key points in the market structure. A level with lots of buy orders might become a strong support level. If price keeps bouncing off this level, it becomes part of the market structure. Key structural levels tend to attract liquidity. Traders often place their orders around important structural points, like trend lines or previous highs and lows. This creates a feedback loop where structure and liquidity reinforce each other. Breaks in structure can drain liquidity. When price breaks through a key structural level, it often leads to a surge in trading activity. This can temporarily drain liquidity from other areas as traders rush to adjust their positions. Liquidity flows with structure. In a strong trend, liquidity tends to cluster in the direction of the trend. For example, in an uptrend, you might see more liquidity above the current price as traders anticipate further rises. Structure helps predict liquidity. By reading the market structure, you can often predict where liquidity might be. For instance, after a series of higher lows in an uptrend, you can expect liquidity to gather below each of these lows. Liquidity confirms structure. Sometimes the way price interacts with liquidity can confirm or deny the current market structure. If price easily breaks through what should be a liquidity-rich level, it might signal a change in the overall structure. Both liquidity and market structure guide price movement. Price often moves towards liquidity, but within the constraints of the larger market structure, and institutional activity links them. Big players in the market often use their understanding of both liquidity and structure to plan their trades. Both liquidity and market structure change over time. Just as market structure evolves, so does the distribution of liquidity. What was a key liquidity level last week might not be as important now, so keeping track of both helps you stay in tune with the market. The interplay between liquidity and structure can help you spot truly important levels in the market. Areas where structural levels align with high liquidity are often the most significant. In trading, we often talk about market structure shifts, the big changes in the overall trend of the market. Inducement often plays a role in these shifts. For example, before a major trend change, you might see price action that looks like it's continuing the old trend. This can trick traders into entering positions in the direction of the old trend, creating liquidity for the smart money to use when reversing the market. Also, liquidity inducement is part of a larger market cycle. The market typically goes through phases of accumulation, markup, distribution, and markdown. Liquidity inducement often occurs during the accumulation and distribution phases, as smart money prepares for the next significant move. During accumulation, for instance, you might see price action that looks choppy and directionless. This can discourage retail traders and shake out weak hands, while smart money quietly builds positions. The apparent lack of direction is itself a form of liquidity inducement, creating opportunities for larger players to buy at favorable prices. This is why it's key to look beyond just price action and also consider volume, momentum, and other factors that might indicate the true market dynamics. There are several tools and indicators that can help you spot and analyze liquidity in the markets. First one, volume. This is one of the simplest and most effective tools. High volume often shows high liquidity. So look for volume spikes, which can indicate liquidity events. Second, market depth charts. These show pending buy and sell orders at different price levels. They can help you see where liquidity pools might be forming. Third, time and sales, or tape reading. This shows real-time trades. Large trades or clusters of trades at certain prices can indicate liquidity. Fourth, order flow indicators. These advanced tools try to show the balance of buying and selling pressure. And fifth, volume profile. This shows where most trading has happened at different price levels, helping identify high liquidity zones. It's best to use a mix of tools and combine them with market structure and price action. Also, these tools don't directly show liquidity. They show things that often relate to liquidity. You still need to interpret what they're telling you. Liquidity and order flow analysis are closely linked. Order flow analysis is all about understanding the buying and selling pressure in the market. This pressure often shows up as liquidity. Order flow analysis looks at the actual orders coming into the market. It tries to spot where big players are buying or selling. Basically, order flow analysis can help you find where liquidity is building up, when liquidity is being used up, and potential price levels where big players might be active. In order flow analysis, you need to get familiar with several concepts. First one, volume clusters. Order flow analysis often looks for clusters of orders at certain prices. These clusters are actually liquidity pools. Next concept is absorption. When a price level absorbs a lot of orders without moving much, it's often a sign of high liquidity. Here's a familiar concept: imbalances. Order flow tools might show imbalances between buy and sell orders. These imbalances can create or drain liquidity. Liquidity tells you where price may be drawn to, but once price gets there, you need to know what is actually happening inside the move. That is where volume comes in. The main idea is simple. Volume should match price moves. If prices go up, volume should too. If prices fall, volume should rise. When volume and price don't match, it can mean trouble. Wyckoff saw the market as a fight between buyers and sellers. Volume shows who's winning. High volume on up moves means buyers are strong. High volume on down moves means sellers are in control. We talked before about Wyckoff's law of effort versus result. This law says the effect of a price move should match the effort behind it. The effort is shown by volume. The result is the price change. Here's how it works. Big volume, the effort, should lead to big price moves, the result. Small volume should lead to small price moves. If there's a mismatch, it can signal a change coming. High volume with little price change often means accumulation or distribution. Low volume with big price moves usually isn't sustainable. Rising prices with falling volume can mean the uptrend is weakening. Volume helps confirm price action. It's like a lie detector for price moves. Price alone can sometimes lie, but price and volume together usually tell the truth. But it's not just about whether volume is high or low. The spread, the body of the price bar, matters too. Wyckoff and later traders like Tom Williams saw the relationship between volume and spread. Here's what to look for: wide spread and high volume. This means usually bullish. Wide spread and high volume. This means usually bearish. Narrow spread and low volume often means consolidation. One common pattern is a climax. This is a day with very high volume and a wide price range. It often marks the end of a move. In a downtrend, it might be a selling climax, marking the end of the drop. In an uptrend, it could be a buying climax, signaling the end of the rise. After a climax, watch for a test. This is when prices return to near the climax level, but on lower volume. If the test holds, it can confirm the end of the old trend and the start of a new one. Volume can also help spot manipulation. If you see a big price move on low volume, be suspicious. It might be a false move designed to trick traders. We'll talk about this later. Real sustainable moves usually come with solid volume. In the wake-up method, volume isn't just about quantity, it's about quality too. A day with steady buying is different from a day where all the volume comes in one big spike. Learn to read the quality of volume, not just the quantity. One key skill is spotting divergences between price and volume. If prices are making new highs, but volume is dropping, it can mean the uptrend is weakening. If prices are making new lows, but volume is drying up, the downtrend might be running out of steam. Volume patterns can also hint at what's coming. For example, expanding volume as prices move sideways often precedes a breakout. The direction of the breakout isn't certain, but the increase in volume suggests something big is cooking. In accumulation, you might see a series of high volume down days that fail to push prices lower. This is often followed by an upward surge on even higher volume. This pattern can signal the end of this phase and the start of markup. In distribution, you might see a series of high volume up days that fail to push prices higher. This is often followed by a downward plunge on even higher volume. This pattern can signal the end of distribution and the start of markdown. Volume can also help with timing. In a strong trend, wait for a pullback on lower volume before entering. This often provides a good entry point with lower risk. And one final point about this, volume often leads price. You might see volume patterns change before price patterns do. This can give you an early warning of potential trend changes. Now you can read structure, liquidity, and effort, but you still need to know where price may react. That is where order blocks come in. Order blocks are special candlesticks that start big price moves. They're not just any candles, they're the ones big market players use to kick off trends. When you see a big market move, it didn't just happen by chance. It started somewhere. And that starting point is an order block. It's where the big players, the market makers, set up and get ready to push the price around. Order blocks form because of liquidity. The big players need a lot of liquidity to make their moves. And when they can't find enough liquidity to fill their orders, they make it themselves. They do this by opening positions in both directions, creating fake counter liquidity. This lets them fill up the volume they need and then push the price where they want it to go. There are two main types of order blocks you need to know about. Bullish order blocks, which show up when the price drops, then suddenly shoots up. And bearish order blocks, the price climbs up, then suddenly drops. Order blocks are like pressure points in the market. They're areas where the big players, the market makers, have put a lot of their orders. When the price comes back to these areas, there's a lot of potential energy waiting to be released. Think about it. When a big player wants to buy a lot of stock or currency, they can't just place one big order. That would spike the price, and they'd end up paying way more than they want to. So instead, they break up their big order into smaller pieces. They might start by selling a little bit. This pushes the price down and scares some other traders into selling too. Now there's more supply in the market, which is exactly what the smart money wants. They can now start buying at these lower prices. This process creates our order block. The initial selling creates the block part, the area on the chart where a lot of orders were placed. And because this is where the smart money started their buying, we know they're likely to defend this area if the price comes back to it. That's why order blocks are so powerful to trade. You're not just guessing where the price might go. You're looking at where the big money has already shown its hand. This is why order blocks will help you place better trades. They give you a solid spot to put your own orders when you're entering a trade. This isn't just guesswork. It's based on where the big players are putting their money. You're not just picking random points. You're using levels that have real significance in the market. Now, here's the reality. Order blocks aren't magic bullets. They only work if you know how to spot real liquidity in the market. On their own, order blocks don't mean much. In fact, most of them break as soon as the price comes back to them. I'll explain later the secret to find the best areas, but for now, think about this. Why does the price bounce off these order blocks? Well, it's all about the big players' average price. If the price drops below a bullish order block or jumps above a bearish one, those big players start losing money. And trust me, they don't like losing money. So they push the price back. It's like they're protecting their turf. This is why you often see that price returns to an order block before continuing its main move. Remember this part. Order blocks are based on a lack of liquidity when smart money needs to open positions. The market makers aren't just reacting to the market. They're actively shaping it. They're creating the conditions they need to make their moves. Let's say we have a bullish order block. The price has gone up from this area, but now it's coming back down. As it approaches the order block, several things might happen. First, the big players who bought here before might buy again. They know this level worked before, so they're happy to add to their position. Second, traders who missed the first move up might see this as their second chance. They'll start buying, adding to the upward pressure. Also, traders who sold short after the first move up might start to get nervous. If the price bounces here, they'll be in trouble. Some of them might start buying to close their shorts, adding even more upward pressure. All of these factors combine to make the order block a strong support level. And if the price does bounce here, it confirms the strength of the order block, making it even more likely to work again in the future. Now let's break down the anatomy of an order block. We are looking for a specific shape here. For a bullish order block, we want to see a move down, then price shooting up. For a bearish order block, price climbs up, then suddenly drops. Now, we're not just looking at a basic reversal. We want the last push, the last candle before the big move. It's the final gasp of the old trend before the new one takes over. This is where the big players make their move. You're looking for the last candle before the reversal. In a bullish scenario, it's often the last red candle before a string of green ones. For bearish setups, it's the last green one before the red candles take over. So for a bullish order block, we are looking at a down candle, but not just any down candle. We want the lowest red candle in the sequence. For a bearish order block, it's the highest green candle. These are our signal flares. They tell us where the action is happening. Some traders use the mean threshold for identifying these zones. It's like the equator of order block. We draw it right through the middle, at the 50% level of the candle. It's like a discount premium zone for the order block. This is where we expect the price to behave itself. If price respects this level, it's a good sign our order block is legit. It's all about validation. A strong order block shouldn't see price dip below this midpoint for bullish blocks, or rise above it for bearish blocks. If it does, it might be telling us our block isn't as solid as we thought. For a bullish order block to be confirmed, we need to see a more recent candle trade through the high of our red candle marking the zone. For a bearish block, we need a candle to trade through the low of our highest green candle. And for a top-notch bullish order block, we don't want to see price trading below the midpoint of that candle. For a bearish block, we don't want price popping above the midpoint of the green candle. Now, let's zoom out a bit. Where do we find these order blocks? We need to look at the highs and lows of the market. These are the optimal reversal spots. the turning points where the smart money makes its move. Now let's talk about the mitigation of order blocks. Mitigation is just a fancy word for cleaning up leftover orders. After a big player has bought what they wanted, the price often swings back to the order block. That's because that's where those initial orders are sitting. The big player wants to close them out, ideally at break-even. This back and forth creates the swings we see in the market. It's like a dance. Buy and then sell. Create an order block, then mitigate it. So how can you use this info? Well, it gives you a roadmap of sorts. When you spot an order block, you can expect price to come back to it at some point. That's your chance to hop on the ride. If you see a bullish order block, you're looking for buy opportunities. For bearish ones, you're thinking about selling. Remember, it's all about liquidity, or rather, the lack of it. When the market makers need to open a position, they often face a problem. There's not enough liquidity to fill their orders without moving the price too much. So they get creative. They open positions in both directions. It's like they're creating their own liquidity pool. They fill up the volume they need, then push the price where they want it to go. This is what creates our order block. When they do this, they are left with some positions that are now losing money. And like I said, big players don't like losing money. As us, retail traders, they want to close these positions at break-even. And the break-even point is right back at our order block. This is why price often comes back to test an order block. It's not random. It's the big money trying to clean up their positions. And for us smaller traders, this is an opportunity. Here's the difficult part. Not every order block gets hit, and some get blown right through. How do you know which ones to trust? It all comes down to liquidity. Liquidity is just a fancy word for where the money is. It's where a lot of buy or sell orders pile up. Often these are at old highs or lows. Big players love to target these spots because that's where they can find enough orders to fill their big positions. So when you're looking at order blocks, pay attention to nearby liquidity. If there's a juicy pool of orders just beyond the order block, chances are good that price will come back to hit it. This is part of the mitigation phase. Mitigation is when price swings back to the order block. Remember those leftover orders from the initial move. This is the time when smart money clean those up. They're closing out positions, getting back to even. For us, retail traders, this is opportunity knocking. When price swings back to an order block, it's often setting up for another move in the original direction. So if it was a bullish order block and price comes back down to it, that might be your chance to buy. Some may buy as soon as price touches the order block. Others wait for signs that the mitigation is done. Price action close, maybe a rejection candle, or a break of a small trend line. We'll talk about the best entries later. There's also a concept called a mitigation block. It's like a cousin to the order block. It's all about how price behaves afterwards. A mitigation block forms when the market fails to make a new high or low. It's a sign that the current move might be running out of steam. It's a failure swing. Here's how it plays out. Let's say the market's been going up. It hits a high, pulls back, then tries to push higher again. But this time, it can't quite reach the old high. That's a mitigation block. It's a hint that the uptrend might be in trouble. The opposite can happen in a downtrend. Price makes a low, bounces, then tries to go lower again. But it can't quite break the old low. That's a bullish mitigation block. It suggests the downtrend might be losing steam. Now don't confuse these with breaker blocks. A breaker actually does make a new high or low. It breaks the old level. A mitigation block falls short. And why does this matter? Well, it's all about understanding what the big players are up to. A mitigation block suggests they couldn't push price where they wanted. Maybe there wasn't enough liquidity, or maybe opposing players stepped in. For you, it's a heads up. If you see a mitigation block form, it might be time to start looking for a reversal. Now, before we continue, let us know in the comments what topics you'd like us to cover in future videos, and drop us a like to help us with YouTube algorithm. Order blocks fit into the bigger picture of market structure. Market structure shows the overall flow with its twists and turns. Order blocks are areas where the flow can suddenly change direction. In a bullish market, you'll see a series of higher highs and higher lows, and each swing up is usually kicked off by a bullish order block. These blocks are like stepping stones, marking the path of the uptrend. Now flip that for a bearish market. You've got lower lows and lower highs. Each drop often starts with a bearish order block. But here's where it gets interesting. Order blocks don't just go with the flow. They can signal when the flow is about to change. This is where market structure breaks come in. A market structure break happens when price busts through a key level. In an uptrend, it's when price makes a lower low. In a downtrend, it's a higher high. These breaks are big deals. They're like road signs telling you the trend might be changing. Now guess what often comes right before these breaks? That's right, order blocks. The market coils up at the order block, then a structure break follows. Here's how it might play out. Let's say we're in an uptrend. We've got those higher highs and higher lows. Then price forms a bearish order block. Price drops from there, and this time, it doesn't just make a higher low. It smashes right through the previous low. That's a structure break. This combo, order block plus structure break, is very powerful. It's telling you something big might be happening. The trend that's been chugging along might be running out of steam. When you spot an order block, don't just focus on that single level. Zoom out. Look at the bigger picture. Where is this block in relation to the overall trend? If it's going with the trend, it might be a continuation signal. Price could bounce off it and keep moving in the same direction. But if it's against the trend, it could be setting up for a reversal. If price respects the block and bounces, it could be a continuation of the current trend. But if it breaks through, especially with a strong move, watch out. That could be the start of a new trend. This is where those market structure breaks come in. If you see price break through a significant high or low after hitting an order block, that's a big deal. It's like the market is shouting at you that something's changing. Another setup to watch for is the failed order block. This is when price comes back to an order block but doesn't bounce off it like expected. Instead, it pushes right through. This can also be a tradable signal. Failed order blocks often lead to strong moves. That's because a lot of traders are caught on the wrong side. They were expecting the block to hold, and now they're scrambling to get out. This can fuel a big move in the opposite direction. A quick word on timeframes. Order blocks work on all timeframes, but they are most powerful on the higher ones. An hourly order block is usually more significant than a 5-minute one, but that doesn't mean you should ignore the lower timeframes. In fact, you can use multiple timeframes together. Find the big order blocks on the higher timeframes, then zoom in to the lower ones for more precise entries. It's like using a map and a GPS together. We'll talk about this later. High probability order blocks are followed by fair value gaps. These happen when price jumps from one level to another, leaving a gap. But unlike a regular gap, there's some trading activity in between. This imbalance signifies a sudden surge in buying or selling pressure, indicating the presence of institutional orders. These gaps show up as big candles on charts. The candles next to them don't touch fully. To spot a fair value gap, look at 3 candles in a row. In a bullish gap, The low of the third candle is above the high of the first. For a bearish gap, the high of the third candle is below the low of the first. These gaps aren't just random. They show where big players made moves. When a large order hits the market, it can cause a gap. And the market often wants to fill these gaps later. Both order blocks and fair value gaps are about imbalances in the market. When price jumps, it means one side, buyers or sellers, took control fast. This quick move can leave some trades unfilled. Fair value gaps are all about speed. When price moves too fast, it can leave these gaps behind, and the market wants to fill them. That's why they often act like magnets, pulling price back to them later. Order blocks and fair value gaps work well together. You'll often see a bullish order block, followed by a fair value gap. This is like a double confirmation of a key buy level. Or you might see price move away from a bearish order block, followed by a fair value gap. Later, when price comes back to fill that gap, it might also retest the order block. This could be a high probability setup. Also, don't forget about the bigger picture. Order blocks and fair value gaps are just parts of market structure. They fit into larger trends and patterns. Always keep the overall market direction in mind. The best order blocks have three key parts: a liquidity run, a break in market structure, and a fair value gap. Let's break this down. First, a liquidity run. This is when price moves fast to hit a bunch of orders. It's like a quick raid. Price shoots up or down, grabbing liquidity. This move often tricks traders. They think the trend will keep going, but it's just a setup for a reversal. Next, we have a break in market structure. This means the market's behavior changes. It could be a shift from an uptrend to a downtrend, or a continuation in the previous trend, or it might be a big move after a quiet period. This break shows something new is happening. A new high or a low must be formed from the order block. Last, the presence of a fair value gap. When you find all three of these conditions together, you've got a high-quality order block. It's like a perfect storm for trading. Let's say price has been going up for a while. Then it makes a quick spike higher. This spike might hit a bunch of stop losses above the market. That's our liquidity run. Right after this spike, price drops hard. It falls below recent lows. This is our break in market structure. The uptrend is now in question. As price falls, it leaves a fair value gap. Just below the order block, there's also a liquidity zone. This whole setup, the spike up, the drop down, the fair value gap, and the liquidity run, forms our order block. If price comes back to test it later, that's a decent short opportunity. The same for a bullish order block. It's all about reading the big player moves. The liquidity run is smart money pushing price to an extreme. They're shaking out weak hands. The break-in structure shows their true intent, and the gap shows how fast and strong their move was. These high-quality order blocks are rare. You won't see them every day, but when you do, they're worth paying attention to. Another signal. Price has been falling. Then it makes a quick drop lower. This might trigger a bunch of sell stops. There's our liquidity run. But right after, price jumps up hard. It breaks above recent highs. This is our change in market structure. The downtrend is now in doubt. As price moves up, it leaves a fair value gap. Above the order block, a potential liquidity zone. This makes it a spot to watch for future buy trades. Again, the liquidity run is smart money pushing price to extremes. The break-in structure is them showing their hand, and the gap shows the power of their move. Always consider the current market context when selecting your order blocks. Prioritize those that align with the prevailing trend direction and fall within the most recent price swing. In an uptrend, focus on bullish order blocks that form within the current upswing, rather than bearish order blocks from previous downswings. And when you find these high-quality blocks, it's best to wait. Wait for price to come back to the block. Then look for signs it's reacting. Maybe it stalls there, or it might make a small move and reverse. These are clues for potential trades. And please be realist. Not every order block will lead to a good trade. Order blocks show where price may react, but fair value gaps and imbalances show something different. They show speed, displacement, and unfinished business on the chart. Fair value gaps show up when price moves fast, skipping over some levels. These gaps happen when buyers and sellers aren't balanced, and traders pay attention to these gaps because they can show where price might turn around or keep going. A fair value gap is a place where price moved so fast, it left a blank space. On smaller time frames, you can see no trading happened there. It's like a vacuum in the market. But these gaps are important because they often act like magnets for price, and the market likes to fill these gaps. This means price often comes back to these levels. They are important because fair value gaps can help you predict where price might go, and they can also help you find good places to enter or exit trades. Markets are always trying to find the right price for things. This is called price discovery. It happens when buyers and sellers agree on a price. But sometimes, the market moves so fast that it skips over some prices. This is how gaps form. Fair value gaps show up when there's not enough trading at certain prices. It's like a jump in the market. These gaps often happen when big players make large orders. They can take all the available trades, leaving a gap. The market wasn't balanced. On one side, there were more buyers or sellers than on the other. And this imbalance can give us clues about where the market might go next. Fair value gaps often act like magnets, and the market likes to fill these gaps. It's like the market wants to go back and check if the price is right. Now, there are different types of gaps. Some happen when the market opens higher or lower than it closed. Others, like fair value gaps, happen during trading. They all show times when the market moved fast and left some prices untested. Fair value gaps will help you see the market's memory. It remembers these gaps and often comes back to them. This can help you predict where price might go or find good places to enter or exit trades. Now, let's address the elephant in the room. There are hundreds of fair value gaps every day. If you trade every gap you see, you'll slowly burn your account. The reality is that fair value gaps are just one piece of the puzzle. On their own, they don't give reliable signals. They work with other market signs to give a full picture. We'll talk about this later. Now let's talk about spotting fair value gaps on your charts. We're looking at a specific 3-candle pattern. For a bullish gap, check if the upper shadow of the first candle doesn't touch the lower shadow of the third candle in the sequence. The space between them is your fair value gap. For a bearish gap, check if the lower shadow of the first candle doesn't touch the upper shadow of the third candle. This area is your fair value gap. The market makes these gaps when big players make aggressive moves. This happens because there's not enough trading activity in that price zone, creating what we call a liquidity void. Think of it like this. A fair value gap shows up during a quick price move where one big player grabs all the available trades. This creates a space where almost no trading happened. The trick is to spot when these candles don't overlap. So in a bullish gap, the high of the first candle shouldn't touch the low of the third. In a bearish gap, the low of the first shouldn't touch the high of the third. When you're looking for these gaps, pay attention to the market structure too. Bullish gaps often show up at support. Bearish gaps tend to form after a rise to resistance. Like I said, in theory, these gaps show up when big players make moves. They can grab all the trades at once, marking an imbalance on the chart. So fair value gaps are closely tied to market structure. They often form at key points in the market's movement, giving us clues about where price might go next. In a bullish market structure, fair value gaps typically form during strong upward moves. The gap shows where buyers were so eager that they skipped over some price levels. This can be a sign that the upward trend is strong. In a bearish market structure, fair value gaps form during sharp downward moves. Here sellers are pushing the price down so fast that some levels get skipped. This can indicate that the bearish trend has strength behind it. Fair value gaps can also mark potential turning points in the market structure. If price returns to fill a gap and then reverses, it might signal a continuation in the existing trend. When looking at market structure, consider different timeframes. A fair value gap on a smaller timeframe might not be visible on a larger one, but it can still affect how price moves in the short term. Remember, structure is all about support and resistance levels. Fair value gaps often act as these levels. Price tends to respect them, either bouncing off or breaking through them with force. In ranging markets, fair value gaps can mark the edges of the range. Price might bounce between these gaps, creating a clear structure to work with. But please understand that these gaps don't exist in isolation. They are part of the bigger picture of market structure. They work alongside other elements like trends, support and resistance, and market phases. If you trade them on their own, you have small chances to make profits. So when you're analyzing structure, look for patterns of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Fair value gaps often form during the strong moves between these swing points. A quick word on timeframes. There can be hundreds of gaps in a single trading day, and they can appear on various timeframes. On shorter timeframes, fair value gaps are more frequent, but have less significance. They can be useful for scalping or day trading when looking for quick entries and exits. But these gaps might get filled quickly, so you need to be fast to act on them. Longer timeframes, like 4-hour or daily, show fewer gaps, but when they do appear, they often have more impact. These gaps can influence price movements for several days. I personally like to use a multiple time frame analysis when working with fair value gaps. For instance, you might spot a gap on a higher time frame, mark the zone, but then zoom in to a lower time frame to fine-tune your entry or exit points. Remember, price is fractal. Patterns that appear on monthly charts can also be seen on daily or even 5-minute charts. This principle applies to fair value gaps as well. When trading fair value gaps, timing your entry makes the difference. The plan is wait for price to come back to the gap before entering your trade. This strategy works well because these gaps are pulling price back to areas where little trading occurred. Think of this gap as a vacuum in the market that needs to be filled. From a supply and demand view, here's what happens. First, a big market player enters with massive orders. They hit the market so hard and fast that price jumps, creating that gap. During this jump, regular traders can't keep up with the speed, leaving an area where trading activity is super thin. When the gap forms, it creates an imbalance. On one side, you have lots of orders filled, but on the other side, there's barely any trading activity. This imbalance creates a zone of interest that big players watch closely. So the smart move is waiting for price to return to this gap. That's because market makers must find fair value for their positions. They use these gaps as reference points, and when price returns to fill the gap, it's often because market makers are balancing their books. You'll notice something interesting when price comes back to these gaps. It's trying to restore balance between buyers and sellers. This balancing act happens from three reasons. Market makers need to fill their unfilled orders from the original move. Also, other traders spot the imbalance and try to profit from it. And finally, the market naturally seeks equilibrium at these levels. The key to trading these returns lies in understanding the original move that created the gap. If it was a strong upward move, a bullish displacement, the gap below becomes a potential buy zone when price returns. The opposite is true for downward moves. Think about the mechanics. When that initial big player moved the market so fast, they left behind other traders who missed their chance to enter. When price returns to the gap, these traders often jump in, adding to the trading activity at these levels. So from a pure supply and demand perspective, the fair value gap represents a level where demand suddenly overwhelms supply in an upward gap, or supply overwhelmed demand in a downward gap. The market needs to test these levels again to confirm if that imbalance was temporary or part of a larger trend. The return to this area often shows clear price action signals. You might see price slow down as it approaches the gap, or notice smaller timeframe consolidation patterns forming. Watch how price behaves when it returns to fill the gap. Clean, swift moves through the gap might indicate that more movement in that direction is coming. Choppy, slow price action might suggest that the level is being heavily contested between buyers and sellers. So for a bullish setup, wait for price to return to the lower edge of the gap. If price bounces off this level, it could signal a good entry point for a long trade. For a bearish setup, watch for price to come back to the upper edge of the gap. If it struggles to break above this level, it might be a good spot to enter a short trade. While waiting for price to return to the gap, look for specific candlestick patterns to fine-tune your entry. These patterns can give you extra confirmation before you enter a trade. For instance, if you see a bullish engulfing pattern form at the lower edge of a fair value gap, it could signal a strong buying pressure. This might be a good time to enter a long trade. A long wick at the upper edge of a bearish gap could indicate selling pressure, implying a potential short entry. Fair value gaps with a break of structure create powerful trade setups because they combine two major elements that show us exactly where big players are active in the market. A break in market structure happens when price runs through previous swing highs or lows with force, but this break needs a gap inside it to count as valid. Picture the market moving up in a series of higher highs and higher lows. Then suddenly, price drops hard through a previous swing low. During this drop, if we see a gap where the candle wicks don't overlap, that's our gap. Big players pushed price down with real force. This area become a magnet that pull price back later. Another example, you see price moving up, making higher highs. Then a large player hits the market hard, breaking below a key swing low. During this break, 3 candles form. The middle one creates a gap. This gap implies the break-in structure might be real. This combination works well because it shows two things. The market structure break tells us the trend is changing, and the gap shows us exactly where big players left their footprint. The presence of both signals means more than just a random price move. It shows intentional, institutional trading activity. When price returns to these levels later, it often finds strong support or resistance. What makes this setup special is the vacuum effect created by the gap. Remember that during the fast move that broke market structure, some orders didn't get filled. This creates an area where price needs to return to find fair value. You'll notice these setups work best when three conditions are met. First, when the break-in structure is clean and strong, the fair value gap forms right at the point where structure breaks. And third, price moves away quickly after creating the gap. So when market makers move price fast enough to break structure and leave a gap, they're showing their hand. They're telling us they have strong interest at these levels. The same for a buy signal. Look for a clear break of previous swing highs. Check for a gap forming during this break. Then wait for price to return to the fair value gap level. And watch how price reacts when it hits the zone. The setup becomes even stronger when the gap coincides with the actual breakpoint in market structure. This creates a double reference point that market makers use to balance their books. The liquidity void that comes with the fair value gap adds another layer of confirmation. It shows that one side of the market was completely overwhelmed during the move. This imbalance needs to be corrected, which is why price often returns to these levels. So after spotting the break in structure and gap, don't chase the initial move. The best trades come when price revisits these levels and shows clear reaction. This gap becomes a key reference level for the new trend direction. Supply and demand zones mark the spots where smart money builds positions. Think of them as launching pads where big trades start. When you find a fair value gap near these zones, you've spotted a place where institutional traders showed their hand twice, first building positions, then moving price fast enough to leave a gap. The strategy works through a simple market truth. Price wants to trade where it hasn't traded before, and those gaps represent prices where little to no trading happened. Markets need to fill these gaps to find fair value. That's why price often returns to these levels. Watch how this plays out on charts. First, you'll see price moving normally. Then suddenly, a large candle appears with no overlap to nearby candles. This tells you someone big just moved with purpose. If this happens near a supply or demand zone, pay extra attention. The process follows clear steps. Price builds up in a supply or demand zone. Then it moves explosively, creating the gap. This fast move shows institutional conviction. Later, price must return to fill this gap. Another signal. You see here a clean fair value gap, where candle shadows don't overlap. The bigger the gap, the stronger the signal. As this gap forms near this demand zone, you've found a sweet spot. Then you wait for price to return to the gap area. Watch how it reacts. Strong moves often follow once the gap starts filling. In combination with a supply or demand zone, I don't mind if price completely fills the gap and even moves past it. I always wait for it to return to the origin point, to the demand zone. The technical reason this works ties to liquidity. Gaps mark areas with little trading activity. When they sit near supply or demand zones, you get two powerful forces working together: the need to fill the gap and the strength of the original zone. Your edge comes from spotting these combinations early. Look for clean gaps. Check if they formed near strong supply-demand zones. Also, remember the previous chapter. Look if this move caused a break in market structure. These setups offer clear entry points with defined risk. This is a clear example of how big players move markets. They build positions in zones, create gaps with fast moves, then let price return to fill them. Each step leaves clues on charts through price action. Price moves this way because markets seek liquidity. This creates a rhythm you can trade: accumulation, expansion, gap creation, then gap filling. Fair value gaps in premium or discount zones show where smart money plans their moves. Market makers work in specific ways at these spots. In discount zones, they start buying. In premium zones, they start selling. This creates a rhythm in the market, a back and forth movement you can trade. The power of this setup comes from market maker behavior. They need to do fair valuation for both their entry and exit positions. This means they look at premium and discount zones as places to start big moves. You need to see the bigger picture first. Look at the total range of the larger price move. Find where price sits compared to recent highs and lows. Then spot the reference points market makers watch, the fair value gaps and liquidity voids. The middle ground, called equilibrium, marks the 50% point between swing highs and lows. This helps you know if price sits in premium or discount. Market mechanics make this work. After big market moves, most traders chase the trend. Smart money does the opposite. They expect a pullback before the next move. These pullbacks often happen right at fair value gaps in premium or discount areas. The process shows up clearly on charts. Sharp price runs left behind gaps, areas where little trading happened. These spots become targets for future trades. When they sit in premium or discount zones, they mark prime trading opportunities. So watch how price behaves in these zones. In premium areas with a fair value gap, look for selling pressure. In discount areas with gaps, watch for buying pressure. The mix of zone location and the gap creates stronger signals. Remember what we talked before. Market structure plays a key role too. True breaks in structure often leave gaps behind. These gaps confirm the break's strength. When they form in premium or discount zones, they show even more power. Again, the best trades come when multiple factors line up. Zone location, gap presence, break-in structure, and clear price action. Market makers use these areas to build positions. They accumulate in discount zones and distribute in premium zones. And finding gaps at the spots shows you where they plan to move price next. The strategy works because it follows market maker goals. They need to find fair value for positions. Premium and discount zones mark places where they take action. Fair value gaps in these zones show exactly where they moved with force. Best trades develop this way. Price reaches a premium or discount zone. You find a gap nearby. Then price shows reversal signs. The whole process repeats in cycles. Price moves between fair value, premium, and discount, and each cycle leaves gaps behind. Now you know where price may move, where it may react, and where it may rebalance. But the market will not make it easy. Before many clean moves, price often traps breakout traders, sweeps liquidity, and makes the wrong side enter late. This is where we study manipulation, fake outs, and trap patterns. Wyckoff talked about the composite operator in his books. This isn't one person. It's a way to think about all the big players as if they were one. These big players include banks, hedge funds, and other pros, and they often act in similar ways. They're all trying to make money, and they have more info and power than regular traders. The composite man isn't real. It's a tool to help us understand the market. It's like pretending the market has a mind of its own, and this mind is smart and sometimes tricky. Here's what the composite man does. He buys when prices are low. He sells when prices are high. He acts in its own interest, and he knows how to move prices. The composite man doesn't control the whole market, but it has a big impact. It can push prices up or down for a while. The composite man concept helps explain why markets often move in ways that seem odd. Why does price drop right before a good news release? The composite man might be selling into the excitement. Why does a market sometimes go up on bad news? The composite man might have already sold. The bad news was expected. Now it's buying again at lower prices. Trading with the trend is key. If the composite man is pushing price up, don't try to short. You'll probably lose. Go with the flow. Again, always check volume. It's the footprint of the composite man. Big volume moves are often important. The composite man links to other Wyckoff ideas. Springs and upthrusts are often the work of the composite man. We'll talk about these in a minute. This concept also explains why stop hunting happens. The composite man knows where stops are likely to be. It can push price to hit those stops. Then it trades against the stop orders. You'll soon realize that many price moves aren't random. They're often planned. True or false? The more times price tests a level, the stronger it gets. If you said true, you just fell for their trap. Ask any trader about support and resistance, and they'll tell you the same thing. The more times a level gets tested, the stronger it becomes. This idea shows up in every trading course, every book. But here's the truth. This statement is completely wrong. This lie costs retail traders millions every day. Let me show you why. Look at this chart. You see this support level getting hit over and over. Most traders think this makes it stronger, more reliable, a better place to buy. They're wrong. Every time price hits that level, it eats up buy orders. Think about it. Someone places a buy order at support. Price hits it. Order gets filled. That buyer is gone. Price hits again. More orders get filled. More buyers disappear. Each test makes the level weaker, not stronger. Watch any forex pair during London Open. See those support levels that held during Asian session. They get tested repeatedly because there's no real buying interest, just small orders from retail traders. When London banks start trading, they blow right through these strong levels to hunt for liquidity below. Here's what really happens. Strong levels push price away fast. No hesitation, no multiple tests, just pure momentum. Price bounces hard and moves. Real support doesn't mess around. When price hits a truly strong level, it bounces hard and fast. You'll maybe see long wicks on the candles, or you'll see massive opposite candle colors. Price gets rejected immediately. No hanging around, no multiple tests. This happens because there's massive buying interest sitting at that level. Smart money has placed their orders there. When price touches that zone, all that buying power kicks in at once. Price shoots away from the level like it hit a trampoline. Real support acts like a steel wall. Price hits it once and bounces violently. You see massive green candles shooting away from the level. No second chances, no hanging around. Just pure buying power defending that zone with everything they have. Watch gold market during any major crisis. When it hits real support, the bounce is immediate and violent. No multiple tests, no consolidation. Just institutional money stepping in with billion-dollar buy orders that send price screaming higher. If price can casually drift around the support level or keep coming back to test it, that tells you the buyers aren't that committed. The level is weak, not strong. When you see a level getting tested multiple times, that's not strength, that's weakness. That's the level getting ready to break. Look at this example. Price tested this support multiple times. Each test ate up more buy orders. At the last test, there's nothing left. Price crashed through like tissue paper. Same thing happens with resistance. Each test removes sell orders. Eventually, no sellers remain, so price breaks up easy. I avoid buying support that gets tested multiple times. The math is simple. More tests equal fewer orders left. Fewer orders equal easier breaks. Now here's what I look for instead. Price drops to support and bounces fast, hard. Leaves a long shadow on the candle. That's liquidity getting cleared out below the level. That shadow tells me something big. Smart money just swept up all the stop losses below support. They grabbed cheap prices. Now they want price higher. That's where I buy, not at the clean level everyone sees, at the broken level where smart money just loaded up. This trade works 10 times better than buying clean support. Price action leaves clues everywhere. The biggest clue is how price leaves a level. Slow grinding moves away from support show weak buying. Explosive moves show serious money enter the market. Think about it mathematically. To create a massive green candle, buyers have to absorb every single sell order and still have enough buying power left to push price higher. That takes serious capital. Retail traders can't create those moves. When I see price explode away from a level with huge volume, I mark that zone immediately. Someone with deep pockets made a decision there. When price returns to that level, the same player often defends it again. It's all about imbalance. When buyers and sellers are equal, price moves sideways. Boring, slow, no money to make. But when one side overpowers the other, that's when magic happens. Picture this. Price sits at support. Suddenly, massive buy orders flood in, way more than the sell orders available. Price explodes higher. That buying pressure had to come from somewhere. Someone with deep pockets, someone who knows something. Here's the key insight. The stronger the move away from a level, the more interest exists there, especially when price didn't spend much time at the level. So when price rockets up from support, remember that spot. Next time price comes back, that's where you want to buy. Look for extreme turning points, violent moves, explosive breakouts. They show you where smart money operates. Those levels become magnets. Price always wants to return to where the big money played. But here's where most traders mess up. They wait for price to come back to the exact same spot. That's not how it works. Smart money doesn't buy at the same price twice. They buy below it, in the discount zone, where retail traders get scared. Here's what changed my trading forever. Sometimes price breaks support, triggers all the stop losses, then immediately reverses back above. Most traders see this as a false breakdown. They think their analysis was wrong. Their analysis was perfect. That's exactly why it failed. Smart money knew where every stop loss was placed. They pushed price just below support to trigger those stops. Each stop loss becomes a market sell order, giving smart money the liquidity they need to buy. Once they fill their positions, price rockets higher. This isn't a failed trade, it's a successful manipulation. The support level worked exactly as expected. Smart money just used it differently than retail traders. I call these liquidity clearouts. They happen every single day. Just watch any major pair at the London Open. Price breaks below Asian session support, sweeps the stops, then reverses immediately. The candle pattern tells the whole story. You see price pierce support with the candle body, but it closes back above. That long wick below, that's smart money collecting liquidity. The close above support, that's them defending the level after filling their positions. Market makers run a business. They need to fill massive orders for clients without moving the market. If a pension fund wants to buy $500 million worth of Apple stock, the market maker can't just hit the buy button. They need liquidity, lots of it. Where do they find this liquidity? From other traders trained to trade obvious patterns. Here's their playbook. First, they let price consolidate between clear support and resistance. Retail traders mark these levels on their charts. Everyone prepares to buy support and sell resistance. Moving averages cluster together. Indicators line up perfectly. Then the market maker makes their move. They push price just above resistance. Every retail trader sees the breakout. Technical indicators confirm it. Moving averages crossover. It's the perfect setup from every trading book. Retail traders buy the breakout. Their buy orders provide the liquidity market makers need to sell their massive position at higher prices. Once filled, the market maker stops supporting the price. It collapses back below resistance, stopping out every breakout buyer. Market manipulation isn't some conspiracy theory. It happens every single day, right in front of your eyes. It's because smart money needs stealth. They need to spread their orders over time. They need liquidity around support and resistance levels. That's where all the retail orders cluster. They know you place stop losses below support. They know you buy when price breaks resistance. They know exactly how you think, and they use that knowledge against you. Here's how the trap works. Price approaches a key resistance level. You see the break coming. You get ready to buy the breakout. Price breaks through. You buy. And it feels right. You are trading the momentum. But look closer. Who was on the other side of your trade? The smart money who bought way down below. They're taking profit at the exact spot you're entering. You buy at the high. They sell at the high. You think you're catching the move up. They know the move is over. This happens thousands of times per day. Small traders buy the highs. Smart money sells the highs. Retail sells the lows. Smart money buys the lows. The solution: stop entering where the pros are exiting. Remember this phrase: buy weakness, sell strength. When price hits extreme highs, that's strength. That's where smart money sells. When price drops from those highs, that's weakness. That's where smart money buys. You want to join them in the weakness, not fight them at the strength. Look at this example. Price makes a new high. Retail traders buy the breakout. Price immediately reverses. Retail gets stopped out. Meanwhile, smart money waits. Price drops back into value, into the discount zone. That's where they buy. See the difference? Retail chases price higher. Smart money lets price come to them. Price spends most of its time doing nothing, just chopping around, going sideways. Traders hate this. No clear direction, no obvious trades, just noise. But smart money loves consolidation, because that's where they set their traps. Here's how it works. Price consolidates. Retail traders get impatient. They start drawing support and resistance lines at the edges of the range. Everyone sees the same levels. Everyone has the same plan. Buy the breakout up, sell the breakdown. Smart money knows this. They see the same levels, but they have a different plan. They want to collect all those breakout orders, all that liquidity. So they push price just outside the range, just enough to trigger the stops and breakout trades. But here's the devious part. They don't break it cleanly. They push price just far enough to trigger technical signals. Moving averages cross. Oscillators break key levels. Every retail trading system flashes the same signal at the same time. So obviously, retail traders see the break and they jump in. But as you know by now, it's a fake break. Smart money is on the other side, taking the opposite position, using retail's momentum against them. The break then fails and price snaps back into the range. This gets worse with indicators. Moving averages bunch up during consolidation. When price breaks out, the averages cross over. This gives retail traders even more confidence. But smart money set this up. They know exactly what signals retail traders watch. They know exactly how to trigger those signals. By the time the indicators confirm the trend change, smart money already made their move. The real opportunity is gone. The lesson is, don't trust obvious breaks. Don't trust indicator signals during consolidation. These are traps designed to separate you from your money. During consolidations, the difference between professional and retail entries is evident. It's completely backwards from what you'd expect. Retail traders buy strength. They see price breaking resistance, making new highs, and they chase it higher. Professionals are selling into that strength. They're distributing positions they bought during weakness. Retail traders sell weakness. They see price breaking support, making new lows, and they panic sell. Professionals are buying that weakness. They're accumulating positions to sell during the next wave of strength. The psychological difference is everything. Retail traders need confirmation. They need to see price already moving before they act. Professionals act on probability. They position themselves before the move happens. Let's talk more about liquidity. Fancy word for a simple concept. Liquidity means orders, buy and sell orders, the fuel that moves price. Smart money needs massive liquidity to fill their huge positions, so they create situations that make you want to trade. They form patterns you recognize. They trigger signals you trust. They make you think you found a great opportunity. But you're not finding opportunity, you're providing liquidity. Think about triangle patterns. You've traded these before. Price squeezes into a tight range, then breaks out. So you follow the breakout. But how many times did that work? How many times did price immediately reverse after you entered? Smart money uses these patterns as liquidity traps. They know retail traders love triangles, love breakouts, love momentum. So they create fake triangles, fake breakouts, fake momentum. You see continuation, they see reversal. You see opportunity, they see liquidity. The key is thinking like them, not like retail. Ask yourself, if I were managing billions of dollars, where would I want to buy? Where would I want to sell? You wouldn't want to buy at obvious support. Too crowded, too expensive. You'd want to buy below support, where retail traders panic, where you get a discount. You wouldn't want to sell at obvious resistance. Not enough buyers. You'd want to sell above resistance, where retail traders chase, where you get premium prices. Stop losses cluster at obvious levels, just below support, just above resistance, below yesterday's low, above yesterday's high. These clusters create liquidity pools that smart money targets deliberately. Again, think like a market maker for a second. You need to buy 10 million shares without spiking the price. Where do you find sellers? You create them by triggering stop losses. Push price below support. Trigger the stops. Buy the shares from panicking traders. Then let price recover. You filled your order at great prices, while retail traders nurse their losses. This isn't illegal. It's not cheating. It's understanding market mechanics. Stop losses are visible to market makers through order flow. They know exactly where the liquidity sits. They'd be foolish not to use this information. Smart money loves shakeouts. These are their favorite tools. It's how smart money are collecting cheap prices. Once they collect enough positions, they stop selling pressure. Price bounces back above support. The shakeout is complete. Small traders watch in frustration. They got stopped out at the low. Now price is moving up without them. This happens every single day, at every major level. The solution is to trade the shakeout, not the level. When you see price break below support with a long shadow, that's your signal. Smart money just collected liquidity. They want price higher now. When you see price break above resistance, then immediately fail. That's your signal. Smart money just distributed. They want price lower now. Again, trade with the shakeout, not against it. Most traders try to predict where price will stop. They look for resistance to sell, support to buy, reversal points. This is backwards thinking. Instead of predicting where price will stop, trade where price wants to go. Look at the most recent high or low. That tells you the current bias. New high means bullish bias. New low means bearish bias. trade in that direction, not against it. If price just made a new high, look for pullbacks to buy. Don't look for resistance to sell. The bias is up, so trade up. If price just made a new low, look for bounces to sell. Don't look for support to buy. The bias is down, so you need to trade down. This simple shift changes everything. You stop fighting the momentum. You start trading with it. Here's what this looks like in practice. Price breaks to new highs. Instead of looking for where it might reverse, look for where it might pull back. That pullback is your buy opportunity. Price breaks to new lows. Instead of looking for where it might bounce, look for where it might retrace. That retrace is your sell opportunity. You're trading the direction of the most recent momentum, not against it. This keeps you on the right side of the market, the side where smart money operates. Now, this module is about chart proof, full examples, top-down analysis, trade planning, and seeing how all the pieces come together on real charts. This is the model we're looking for. So let's break down a buy signal, step by step. The first thing to spot is a break of structure. This happens when price moves decisively through a previous significant low. We see a downward trend that breaks below a previous low. This break of structure signals a potential continuation in the overall trend. It shows that sellers have overcome the previous support and may be gaining control. After the break of structure, we look for a change of character. This is when the market behavior shifts noticeably. In our example, the price moves up strongly after breaking the previous structure. The change of character is critical because it confirms that the break of structure was just a fake out. It shows that there's real strength behind the move, but on the upside. At this point, traders who were short start to realize they might be on the wrong side of the market. Then we identify the last area of supply, before the change of character. This area becomes significant because it's the last place where sellers were in control before the buyers took over. This area is marked as a possible new demand zone. This is a key price action concept. An area of supply, meaning selling pressure, has now flipped to become potential demand, meaning buying pressure. Big players often use these areas to enter trades. The final step is to wait for a pullback to the area we've marked, and then enter when we see a bullish candle with higher volume than the previous candles. The higher volume is our setup confirmation. It implies that there is strong interest from buyers at this level, increasing the chances that the upward move will continue. The psychology behind this is simple. The pullback allows traders who missed the initial move to enter, and the increase in volume on the bullish candle suggests that institutional traders might be entering or adding to their positions here. So this price action strategy is mainly based on simple market structure movements. It assumes that large institutional traders move the market in ways that often trap retail traders. The initial downtrend and break of structure can be seen as a stop hunt. Large players push the price down, triggering stop losses of buyers. This allows them to enter long positions at better prices. Once they've stored their positions, they push the price up sharply, resulting in the change of character. This catches many traders off guard, especially those who just entered short positions, thinking the downtrend would continue. The pullback to the last supply area could be considered as another trap. Many will see this as a chance to enter short positions, thinking the uptrend was just a temporary move. However, smart money uses this pullback to add to their long positions. This strategy works because it aligns you with the movements of smart money and also takes advantage of market psychology. The break of structure and change of character creates a fear of missing out among traders who missed the initial move. This often leads to a strong trend as more and more traders pile in. And the pullback to the last supply area provides a relatively low-risk entry point. The stop loss can be placed just below this area. Here's another signal. The first step is spotting a break of structure. This happens when price pushes through this previous low, signaling a possible continuation in trend. Next, we look for a change of character. This is when the market really starts to show its hand. Again, you need to understand the psychology behind this setup. Many traders get caught on the wrong side when the market suddenly changes direction. The third step is key. We mark the last supply area before the change of character. This area is special because it's the last place sellers were in control before buyers took over. In price action terms, this area flips from being supply to potential demand. Potential because we don't know yet. The price might break this zone in many cases. That's why the pullback to this newly marked demand area must fulfill the most important condition. The entry signal comes only if we see a bullish candle with higher volume than previous candles. This increased volume means there's strong buyer interest, hinting that big players might be getting involved. Now let's break down the steps for a short signal. The first aspect to spot is a break of structure, but now we're looking for a break to the upside. So we need to see that price moves upward through a previous significant high, signaling a potential trend continuation. It's like the market is testing the waters, seeing if it can continue its previous direction. This time, the break catches buyers off guard, those who were betting on the continuation of the uptrend. After the break of structure, we need a change of character, but now in a bearish direction. This is when the market behavior shifts to the downside, breaking a major swing low. This price action movement confirms that the break of structure was actually a fake out, a trap for buying traders. And also shows that there's real strength behind the downward move. At this point, traders who were long start to realize they've entered at a bad time. And this can lead to some selling as they try to exit their positions, further fueling the downward move. Next, we identify the last area of demand before the change of character. This area becomes significant because it's the last place where buyers were in control before the sellers took charge. This is an important concept. Once an area of demand has been broken, it flipped and became a potential supply, so a possible zone with selling pressure. And we already know that big players often use these areas to enter short trades. The final step is to wait for a retrace to supply, and then enter the short position when we see a bearish candle with higher volume than the previous candles. The higher volume is your confirmation that there's strong interest from sellers at this level, increasing the likelihood that the downward move will continue. The increase in volume on the bearish candle basically means that smart money might be entering or adding to their short positions here. You'll see this pattern every day, multiple times, on all markets and all time frames. The final break of structure can be seen as a stop hunt. Large players push the price up, triggering stop losses of sellers. This allows them to enter their short positions at better prices. Once they've absorbed all the liquidity, they push the price down sharply, resulting in the change of character. As I said, this catches many traders off guard, especially those who just entered long positions thinking the uptrend would continue. And the retrace to the last demand area can be seen as another trap. Many will see this as a chance to enter long positions, thinking the previous downward movement was just temporary. But the smart play here is to use this pullback to find a short signal. Another example. First, we're seeing a break of structure to the upside. We see price moving above a previous significant high, indicating a potential continuation. When price breaks above these levels, it triggers a cascade of new buy orders. At the same time, the stop losses of sellers are hit, and this creates liquidity for smart money to engineer their plan. After the break of structure, we see a change of character in a bearish direction. This is when the market behavior shifts to the downside. The price moves down strongly after breaking the previous structure. It confirms that there's real strength behind the downward move. Next, you look for the last area of demand before the change of character. The last place where buyers were in control before the sellers took over. So this previous area of demand has now flipped and then became a potential supply. We wait for a retracement to our new supply zone and then enter the short trade when we see a bearish candle with higher volume than the previous candles. It's the confirmation of strong interest from sellers at this level. This is a low-risk entry for a short trade. Now, very important, when you spot a setup like this one, consider the larger context of the market. This setup, the break of structure, change of character, and the flip of supply to demand, could very well be part of a larger uptrend, marking the end of a pullback. And trading this setup as a continuation of the previous trend, rather than a reversal, is often the smarter move. Trends tend to persist due to market momentum. When you trade this setup with the trend, you're aligning with the order flow. So at the end of a pullback, this setup is actually a continuation trade in the direction of the main trend. The overall trend shows where the big money is flowing, and it's usually safer to go with the current trend rather than against it. In this example, the market has been in an uptrend for some time. We're seeing higher highs and higher lows. Then we see a pullback. This pullback might look significant on a smaller time frame, but in the context of the larger trend, it's just a retracement. Toward the end of this pullback, we see our setup unfold. First, the break of structure. Price breaks below a previous low. Then the change of character. A strong move up. It signals that the pullback might be over and the uptrend is ready to resume. Then we have the flip from supply to demand. The area just before the change of character, which was previously supply, now becomes potential demand. This is our key level to watch for potential entries. As price pulls back to this demand zone, this is where we look for our entry, confirmed by a bullish candle with higher volume. So by entering here, we're not trying to catch a reversal. Instead, we are joining a trend that's already in place. We're essentially betting that the larger uptrend will continue after this retracement. A successful order block strategy combines trend analysis, order block identification, and precise entry timing. First, you need to figure out which way the market is moving. You'll want to look at a bigger picture, so use a higher time frame chart. Let's say you pick the hourly chart. On this chart, you are looking for the current order flow, in this case, an uptrend. Now that you know which way the market is moving, it's time to find a good spot to enter your trade. The order block should match the overall trend. As the trend is up, look for a bullish order block. Before the order block forms, price should have taken out some liquidity. A bunch of stop losses, sitting just below a low point in an uptrend. If price dips down and triggers the stops before shooting back up, that's a liquidity run. Then the order block should trigger a break in market structure. This shows strength and commitment to the move. The size of the order block candle matters too. Generally, the bigger it is, the more significant it might be. It's like a bigger footprint. It shows that more traders were involved. Also, pay attention to how price reacts after the order block forms. If it moves away quickly and forms a fair value gap, even better. Remember, not every order block will lead to a good trade. Your job is to find the best opportunities. not to trade every signal you see. Another tip, look for order blocks that line up with other technical factors. Maybe it's at a key Fibonacci level, or it matches up with a trend line, or a moving average. The more reasons you have to believe in an order block, the better. Once you've spotted a promising order block on the higher time frame, it's time to zoom in for a closer look. This step is all about finding the perfect moment to enter your trade, timing your entry. So you switch to a lower time frame chart. If you were looking at an hourly chart before, you might zoom in to a 5-minute chart. This gives you a much more detailed view of price action. Your plan here is to wait for price to come back to your identified order block zone. First, check for realignment. This means the price action on your lower time frame should match up with the trend you saw on the higher time frame. As the bigger trend is up, you want to see bullish signs on the smaller time frame too. Look for a smaller version of the order block you found earlier. As you're in an uptrend, you're searching for a bullish order block on this lower time frame, an order block inside the bigger order block. You could also look for a small liquidity grab just before your entry. This is like a mini version of the liquidity run you saw on the bigger time frame. It might look like price dipping down to trigger some nearby stop losses before moving in your expected direction. Another tip to pinpoint your entry, look for any patterns forming on your lower time frame chart. If you see small double bottoms, that's a decent setup. Or maybe there a small change of character. Price is breaking previous swing highs and it's ready to go higher. Remember, the goal here is to fine-tune your entry. You're not changing your overall view of the market. You're just trying to get the best possible entry price. The plan is to enter your trade on the breakout of the lower time frame order block. For this buy order, you place your stop loss just below a recent swing low. And please give it enough room to breathe. Don't try to be too precise with your stop. Your take profit should be ideally at least 3 times higher than your risk. But don't just pick a random number. Look at the chart and find the next logical high point within the higher time frame trend. And consider using multiple take profit levels. You could close half your position at your first target, then let the rest run to a higher target. Here's a pro tip. Order blocks must have a liquidity pool to target. Identify clear liquidity pools above your chosen order block. These pools act as magnets for price. They are like a roadmap for potential price movement after the order block is triggered. In this case, we see a bullish order block with a cluster of previous swing highs above it. This presents a clear liquidity pool that price is likely to target once the order block is triggered. Fibonacci levels match natural market moves, and when they line up with fair value gaps, they create strong trade opportunities. Think of it like using 2 different tools that point to the same spot. It makes that spot much more special. The magic happens because different types of traders watch different things. Some traders only trade fair value gaps, while others only use Fibonacci. When these levels match up, both groups of traders see a good trade opportunity. This creates more buying or selling pressure at that exact spot. The golden zone between the 50% and 61% Fibonacci levels attracts smart money attention. When a gap sits in this area, you've found a place where 2 powerful forces meet. This double confirmation makes your trades stronger. In an uptrend, look for gaps that line up with Fibonacci levels for buying opportunities. In a downtrend, search for gaps matching Fibonacci levels for selling chances. Think about how markets move. After a strong push, price pulls back to test previous levels. Smart traders use Fibonacci to find these pullback targets. When these levels match a fair value gap, They show where big players plan their next moves. The process starts with finding the right swing points. Draw your Fibonacci from the highest high to the lowest low in the recent price action. This gives you the framework for finding the sweet spots where a fair value gap might matter most. A lot of big traders watch these same levels. Some use Fibonacci to plan their trades, looking for spots where they can build or exit positions. And when you see a fair value gap at these levels, you might want to take action. The real power comes from understanding what these confluences mean. Fibonacci levels themselves don't act as support or resistance. Instead, they help you find liquidity blocks, places where fair value gaps show market imbalances. Then watch how price reacts at these spots. A strong gap needs a big, clean separation between candle shadows. When this gap lines up with key Fibonacci levels, especially the 50 and 61% zone, you found a high probability setup. The strategy works because it combines two types of market psychology. Fibonacci shows natural pullback points where traders expect reactions. Fair value gaps show where big money moved fast enough to leave traces. And together, they create stronger signals. Remember that trends make this work better. In a strong uptrend, gaps that line up with Fibonacci levels make great buying zones. The opposite works in downtrends. The trend gives you another layer of confluence, making your trades even stronger. The plan is simple. Wait for price to reach the Fibonacci level where your gap sits. Look for signs that price respects both the level and the gap. The best trades come when price pierces the confluence zone and rejects it with a strong candlestick signal. I look mainly for candles with large wicks or engulfing patterns. Time frames matter too. While this strategy works on any chart, I often watch the 4-hour and the hourly charts. These longer views help you spot the strongest confluences between Fibonacci and fair value gaps. Again, the technical reason this works ties to liquidity. Big players need certain price levels to build positions. They use Fibonacci to find these spots. When they move fast enough to create gaps at these levels, they show their hand twice. Trading becomes simpler with this approach. You don't chase price. Instead, you wait for it to reach these special spots where Fibonacci and fair value gaps meet. This patience puts you in position for high probability moves. The whole process flows naturally. Markets move up or down with force, creating gaps. Price pulls back to Fibonacci levels. When these align, you find spots where smart money are likely to act. Think of confluence like different layers. Each layer, like the gap, Fibonacci, trend direction, the candlestick confirmation, makes your trade setup stronger. The more layers of confluence you have, the higher the probability of your trade working out. And use these confluence zones as areas, not exact prices. Markets rarely turn exactly at a specific price. Instead, they often react within a zone. So give your trades room to breathe by thinking in zones rather than exact prices. I prefer this approach because it also helps you avoid many fake breakouts. Instead of chasing price, you're waiting for it to return to these high probability zones. Volume profile reveals where markets breathe. It transforms flat price charts into living landscapes of trading activity. In technical analysis, volume isn't just a number, it's market memory. In areas where massive trading volumes cluster, something significant happened. And these zones aren't random. They're strategic battlegrounds where institutional money fights. Some price levels accumulate massive trading volumes. These are thick, dense areas representing intense market interest. Other zones remain thin, barely touched. These volume areas tell stories most traders miss. The point of control becomes your guide. This represents the price level with maximum traded volume, a gravitational center where market energy concentrates. Smart traders treat the point of control like a magnetic pole, attracting price action. Volume profile transforms technical analysis from guesswork to strategic mapping. I said it before, it's not about predicting, it's about understanding market psychology. Where did big players concentrate their positions? What trading zones represent maximum activity? The reality is that institutional traders don't chase tons of indicators. They read market microstructure, and volume profile reveals their strategic positioning. Thick profile sections show where massive buy or sell orders clustered. Thin sections is just market indifference. Now, traders often ask how to properly use volume profile. First, look for volume concentration zones. Watch how price interacts with these areas. Does it get rejected? Is it accepted? These interactions reveal market intent. Strong trends leave volume profile footprints. A healthy uptrend shows progressively thicker volume profiles in bullish regions. Weak trends show thin, scattered volume distribution. Markets communicate through these subtle volume signatures. Then combine volume profile with other strategic tools. Fibonacci retracements create powerful confluence zones. When volume profile levels align with Fibonacci zones, you have a trading opportunity. When price strongly reverses, volume profile shows where counterparties became most aggressive. These are not random movements, they are calculated institutional strategies. Footprint charts belong to a broader concept called order flow. Retail traders see candles. Professionals see order flow. When retail traders look at charts, they see candles moving up and down. But professionals see something much deeper. They see the flow of orders, the push and pull of buying and selling. That creates those candles on the charts. While price action alone works well, it only tells part of the story. Footprint charts add depth by revealing if big market players and institutions are actually taking action at these spots. The real magic happens when you mix price action with order flow analysis. This combination takes your trading from basic to professional level. The left side shows selling volume, while the right side shows buying volume at specific price levels. Color intensity matters on footprint charts. On the buy side, on the right, brighter green means higher buying volume, while darker green shows lower volume. On the sell side, on the left, brighter red indicates higher selling volume, and darker red shows lower volume. This area on your chart marks the point of control, the price level with the highest trading volume. This shows where buyers and sellers were most active. Point of control often become an important price level for future trades. The space between value area high and value area low contains 70% of all trading volume. These areas help identify good entry and exit points. The chart also displays three key volume numbers: total buying volume, which is the sum of all green side activity; total selling volume, which is the sum of all red side activity; total overall volume, which is buying plus selling volume. Delta shows the difference between buying and selling volume. Green delta means more buying than selling occurred. Red delta indicates more selling than buying. This helps you spot market pressure and potential trend changes. This is really game changer. You see, most traders make a critical mistake. They trade blind, hoping price will move in their favor. Footprint charts remove that guesswork. They show you exactly what's happening behind each price movement. So start using order flow to see where the big players are placing their bets. Look at the volume of orders, the timing of large trades, and the zones where institutions are likely to jump in. I hope you see the difference. Retail traders might focus on price patterns and indicators, but professionals dig deeper, looking at the flow of money through the market. The concept of order flow might sound hard and intimidating, but it will transform your technical analysis from a guessing game into a strategic endeavor. When you analyze your chart, you can't just look at candles in isolation. It's essential to understand the context in which they occur. This context tells you whether the market is in an impulse phase or a corrective phase. Let's start with impulse movements. These are strong directional moves in the market, where prices trend sharply, either upward or downward. In technical terms, an impulse move is characterized by a series of candles that move in the same direction, often with increasing momentum. This is usually accompanied by high trading volume, which signals strong interest and participation in the market. Now look at corrective movements. These are periods where the market takes a breather, moving sideways or slightly against the main trend. The candles during a correction are typically smaller, and the volume may decrease, indicating less participation. Corrective phases can be seen as consolidation periods, where the market digests previous gains or losses before potentially resuming its trend. Understanding whether the market is in an impulse or corrective phase can significantly influence your trading strategies. Let's say you're observing an upward impulse move. This might be a signal to enter long positions, aiming to profit from the strong upward trend. In contrast, during a corrective phase, you might employ different tactics. You can also use support and resistance levels to determine where these phases might begin or end. An impulse move may break through a resistance level, signaling a strong trend. A correction might occur as the price approaches a support level, potentially reversing or pausing the trend. Combine this with volume profile or footprint charts. During an impulse phase, you often see a surge in volume, confirming the strength of the trend. In contrast, a decrease in volume during a corrective phase implies a lack of conviction in moving against the main trend, hinting that the correction may be temporary. Markets often move to areas with concentrated liquidity. When we talk about liquidity, we are referring to areas where concentrated orders exist. These zones are like magnets that attract price movement, and institutional traders deliberately target these zones to trigger significant market movements. Picture traders placing their stop-loss orders clustered around similar price levels. When price reaches these zones, it creates a cascade of automatic buy or sell orders. This sudden surge of orders can cause sharp, dramatic price movements that catch many traders off guard. The process works like a strategic trap. Traders often place stop-loss orders at predictable levels. Smart money traders recognize these patterns and deliberately push price towards these zones. When triggered, these stop-loss orders generate what traders call sell-side liquidity or buy-side liquidity. For instance, during a bullish market, traders might place stop-loss orders just below recent low points. Big players can intentionally drive price down to trigger these stops, creating a sudden influx of sell orders. This allows them to enter buy positions at more favorable prices. Liquidity pools are not random. They're strategic zones where significant numbers of buy or sell orders get together. These pools exist across different timeframes. In your technical analysis, you must find and analyze these pools to identify potential trade opportunities. Validation of these liquidity zones happens through specific price movements. When price violates a recent low, sell stops become market sell orders. When price breaks above a recent high, buy stops transform into market buy orders. This mechanism injects liquidity and often accompanies smart money positioning. Entry techniques for liquidity hunting require precision. When a market shows bullish characteristics, you might place buy limit orders just below recent lows. This strategy mimics how institutional traders would enter positions, essentially buying the sell stops. The reverse holds true for bearish markets. You can place sell limit orders just above recent highs, selling the accumulated buy stops. This approach allows you to trade like institutional players, taking advantage of predictable market behaviors. Basically, you plan to enter in areas where novice traders are placing their stops. The truth is, institutional traders often create scenarios that manipulate our perceptions. They might make the market appear bearish when they actually want to accumulate buy positions, or they might create a bullish appearance precisely when they aim to gather sell positions. The goal is to trade in low resistance conditions. This means identifying paths with minimal obstacles to profitability. Every time the market establishes a new range, mark the high and low points. Mark the internal and external range liquidity. It's about thinking several steps ahead, anticipating where institutional traders might want to generate order flow. Markets breathe through volume. Every price movement tells a story, but volume reveals the true narrative. When price rises but volume declines, it's like the market is losing steam. Professional traders recognize this as a warning sign. The market might look strong on the surface, but the underlying energy is fading. Volume divergence happens when price and trading volume don't align. Picture a stock climbing higher, but the volume supporting that climb is decreasing. This mismatch signals potential market weakness. Traders call this a volume divergence, a critical indicator of market health. Think of volume as the fuel powering price movement. A rising market needs strong volume to sustain its momentum. When volume drops during an uptrend, it implies the move might be running out of steam. Professional traders see this as traders losing interest or confidence. A strong uptrend should have increasing volume. If volume fails to confirm price movement, it indicates potential trend reversal. So look for these subtle signals to anticipate market shifts. Institutional traders pay close attention to volume patterns. They understand that volume tells a story beyond simple price movement. When volume decreases during a price rise, it might also mean smart money is preparing to exit their positions. This is a classic warning sign. Consider a market climbing steadily. Normally, you'd expect volume to increase as price moves higher. But if volume remains flat or decreases, it suggests lack of conviction. This is a potential sign of market exhaustion. I said it before, volume analysis goes beyond simple up and down movements. It's about understanding market sentiment and trader participation. A rising market with decreasing volume might indicate that fewer traders believe in the current price direction. This could signal an impending trend reversal. When volume fails to match price movement, it raises red flags. So look for these volume nuances and understand that volume is more than just numbers. It's a reflection of market sentiment. A rising market with weak volume might look strong on the surface, but it lacks the underlying support to continue. And another point, market psychology becomes visible through volume analysis. When traders lose confidence, volume drops. This silent signal often precedes significant market movements. A footprint chart helps us see what is happening inside those moves by showing the volume that trades at each price level during each candle. That way, we do not just see a candle's high or low. We also see how many orders occur on the buying side and the selling side at each tiny step of the candle. This detailed view can help you understand absorption and imbalances. Absorption is when large traders soak up orders, stopping price from moving. Imbalances happen when there is much stronger buying or selling at a particular price range, driving price in a direction. In a footprint chart, each candle is split into rows for each price level. You can see how many contracts were traded on the bid side, the sellers, and on the ask side, the buyers. This can paint a vivid picture of whether buyers or sellers are more aggressive at certain price increments. When there are large blocks of sellers at a certain price, you often see a big number on the bid column at that price. If there is strong buying, you see a larger number on the ask column. For day traders, footprint charts can be a revelation. They add a whole new layer to market structure. They can show if there is absorption at a high, meaning there is a strong group of sell orders that keep soaking up buys, so price cannot break through that same high. Or perhaps we see an imbalance of eager buyers stepping in at a certain low, pushing price upward. By looking at inside the candle, you discover that price is not just a line or a bar. It is the result of orders at each small step. If at a critical swing low, we see an extremely large cluster of buy orders that appear to stop further drops, that might warn us that the market is forming a new higher low and could push up again. Whenever price approaches a supply or demand zone, you can look at the footprint structure to see if large traders are unloading or absorbing positions. Absorption is when the market tries to move further in one direction, like going up, but meets a large opposing force, like big sell orders. Those big sell orders soak up all the buying that tries to push price higher, so price cannot really break up. Sometimes after that, we see a reversal. Imbalances are when one side is heavily stronger than the other. You might see large numbers on the buy side, the ask side, with only small numbers on the bid side at the same price level, or vice versa. This market order flow can lead to a swift move in the direction of the stronger force. You see, markets are always about balancing out how many are willing to buy and how many are willing to sell. When that balance is tilted heavily in one direction, price moves quickly. On footprints, an imbalance can show up when you see a big difference in the volume between the bid and ask at a specific price. That is a bullish imbalance because it suggests a lot more people hit the offer. They were eager to buy. If that keeps happening across multiple price levels in a single candle or a short sequence of candles, you know that buyers are strongly in control. The price often shoots up. Conversely, a big imbalance on the bid side is a heavy wave of sells that can drive price down. Now, let's connect absorption and imbalances to the overall structure. Suppose you have an uptrend. You watch the footprints near each pullback. This is where the market dips temporarily, but then tries to continue up. If every time the price dips, you see big buy imbalances on the footprint, that signals the path is likely to keep going upward. The structure remains bullish. Or suppose price tests a previous swing high. Now you see heavy absorption from sellers at that high. Price tries to break but cannot hold above that level. The footprint reveals that the market is not accepting higher prices. A normal chart might just show a candle that poked above and came back below, but the footprint confirms that big sellers were standing in the way. That can hint at a false breakout or a potential reversal if it keeps happening. Imagine you see a strong uptrend making higher highs. Suddenly, it tries to push to a new high but prints less buy imbalance than before. Actually, you notice a spike in absorption on the sell side. If the market fails to hold above that old high and quickly returns below, forming a lower swing high, you may have an early sign of a structure shift. The footprint is telling you that the imbalance from buyers is not as strong, plus sellers are absorbing attempts to break upward. That is possibly the start of a downtrend if the price pushes below a previous swing low. So let's recap. You will find that repeated strong buy imbalances lead to uptrends. Repeated strong sell imbalances lead to downtrends. And absorption near a prior top or bottom signals a potential turning point. The advantage is that you do not have to guess. You see how many trades occurred at each price. So if a level is truly being defended by big orders, it becomes obvious on the chart. The best day trading strategies unify structural and supply-demand logic with real-time price action cues. You don't want to rely on a single pattern or a single zone. Instead, try to piece together the trend context. Watch for a break of structure or a retest near a zone. Confirm on your footprint chart that buyers or sellers are stepping in. Then pull the trigger. This market is trending down strongly overnight. Coming into the London session, the price forms a small consolidation and then continues down, showing multiple breaks of structure to the downside. You then identify a supply zone that sparked a strong move lower. When price retests that zone, you watch your footprints. If you see high levels of selling aggression at that zone, it might confirm the continuation short. While the approach is universal, your personal plan will depend on how frequently you like to trade. Some advanced day traders prefer waiting for quick scalp opportunities around supply-demand interactions. Others might hold positions longer, letting the entire session's trend play out, as multiple break of structure events reaffirm that they are on the right side. During a day, the structure can shift from expansion to consolidation, from bullish to bearish, so you need to adapt. Setting up an intraday trade around market structure might go like this. First, you confirm the daily bias from a slightly higher time frame, such as a 30-minute chart, to see if there is a dominant bullish or bearish theme. You identify major supply and demand levels from that perspective. You then keenly watch for how price interacts with those zones on your shorter time frame, maybe a 5-minute one. If you see an emerging break of structure aligned with your bias, you'll look for confirmation in price action. That might be a strong bullish candle retesting and rejecting a prior pivot, or a footprint reading showing buyers overwhelming sellers. You enter with the logic being purely structural. Then if you see a sign that structure might be shifting again, like a minor change of character, you exit or adjust. From a purely technical standpoint, you can manage a trade by letting structure guide stops and targets. For example, if you go long after a bullish break of structure, you can place a stop below the higher low that preceded your entry. If the market is truly continuing its uptrend, that low should not be violated. For profit targets, you might look at the next major supply zone or the next likely area for a structural shift. Once price gets there, you reevaluate. If you see footprints and price action still supportive of your thesis, you might trail the stop. If not, you can exit, locking in your gains. In your market structure analysis, one pitfall is to read too many signals into every micro swing. You see, intraday charts can be noisy, and you do not want to leap at the first small break of structure if it is overshadowed by the larger trend or the possibility of a false break. So please resist the urge to jump in after a massive directional candle. Instead, wait to see if that move aligns with a confirmed break of structure or a retest. Another pitfall is ignoring the bigger picture. If the market is in a dominant trend that has shown no true sign of reversal, a small change of character on a very low time frame might trick you into a premature position. Focusing too narrowly on each wave can cause constant second guessing. Instead, You want to keep a layered approach that spans multiple timeframes, aligned with major supply and demand references. Small refinements matter for day traders. One approach is to watch a 50-minute chart for structure while using the 5-minute footprint to refine entries. You might see the 15-minute chart break structure for a bullish push, then switch to the 5-minute to see if footprint volumes confirm a surge in buyer activity at the retest zone. Support and resistance can morph as price moves. A region that was tested multiple times might weaken, or it might accumulate more orders. You can watch if each subsequent retest sees smaller or bigger bounces. If bigger bounces occur, that suggests increased demand or supply stepping in. If it starts to flatten, perhaps you are on the verge of a break. Scaling in or out can be a viable technique if you regularly trade intraday. During strong trends, where you are confident of a continuation, rather than entering your full size all at once, you might start with a partial position at the initial break of structure. Then if price retests that break level, with footprints confirming a surge in your direction, you add more. You can exit part of your position at the next pivot or supply-demand zone. If the structure remains strongly with you, you hold the rest to see if a bigger move develops. Your framework should revolve around consistent steps and definitions. For instance, how exactly do you define a break of structure for your time frame? Is it a full close beyond the level or just a wick? How many candles do you wait to confirm a zone retest? You might require at least 2 consecutive closes beyond the swing high to call it a bullish break, for example. Or you might say a supply zone is only valid if price left it with a strong momentum candle. By clarifying these definitions, you reduce impulse decisions. Here are some rules. First, officially define how you recognize an uptrend or downtrend. Second, clarify break of structure triggers for bullish or bearish continuation. Also, specify the difference between potential change of character patterns and the confirmed reversals. And try to map out supply-demand zones in a consistent manner. So here is a generalized step-by-step approach to day trade setups using market structure. First is the pre-market prep. Mark overnight highs and lows. Identify any high-impact supply or demand zones left on the chart from the previous session. Then is the trend check. Check the bigger time frame, the 30-minute or 1 hour, to see if you have an established uptrend or downtrend, or if you suspect a new change of character. Then identify key levels. Evaluate potential breakout points, pivot lines, or supply-demand zones. You then monitor price action. Observe how price reacts near these zones. Look for bullish or bearish candlestick patterns, or specific microstructure like retests, small head fake moves, or partial breaks. Then you use footprint clues. In a strong bullish scenario, watch if the footprint bars confirm heavy bid volume at or above key inflection points. In a potential top scenario, look for absorption clusters on the ask side. Then execute. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.